So this is a lecture video, chapter 15. This is part 2. So just go back, we're just going to go back and just recap briefly. So the concept here is manufacturing costs. Manufacturing costs are the costs of the product. So if we're making a guitar, we're going to include all the direct costs and all the indirect costs at the factory level. These are all going to be part of the product cost. So in other words, all the direct costs such as the wood, the strings, whatever other significant items there are, all the direct labor, so all of the wages of the individual workers who are cutting and assembling and putting together the guitars, all of their costs will be part of the cost of the guitar. But not only that, but all of the factory overhead, all of the indirect costs at the factory level will also be allocated to the cost of the guitar. So that each guitar will include a portion of the factory property taxes, the factory insurance, all of the depreciation on the factory and the equipment, the maintenance expense of the factory, if there's a cafeteria in the factory, the cafeteria expense, all of those costs will be allocated to the cost of that guitar. So there will be no excess expenses at the factory that will not become part of the product cost. All of those costs become part of the product cost. That's very, very important. The only thing that is not part of the product cost are what's called period costs, and those are costs that are shown as, say, on the selling and administrative expense lines on the income statement. So, for instance, marketing, advertising expense, things like that are not at the factory level. They are not manufacturing costs. Otherwise, all manufacturing costs are product costs. So let's go through an example. I'm going to jot down a few of the assumptions real quick, and then we'll resume. Okay, so we're going to do an example here. We're going to basically construct going to determine all of our inventory balances, and ultimately we're going to construct an income statement. And let me put a couple other items here. We're going to assume sales are 36, operating expense are 9. And so the question is, what is our net income? So based on the information that we have, we're going to determine ultimately what our cost of goods sold is, and we're going to be able to create our income statement. So based on the information we have. So let's use these T accounts. It's going to help us visualize how these costs are going to flow through into cost of goods sold. And then, of course, cost of goods sold will allow us to construct our income statement with the information that we have here. And by the way, we could substitute any number of different numbers in here, and eventually we'll be able to solve for any missing items, and you'll see that in the homework. There's a couple of examples where we're going to substitute for different items. The key here, I think, is understanding what goes where in the T accounts, how the costs flow through, and then, of course, the terminology. Okay, so I'm going to abbreviate just to keep things simple so it doesn't get too cluttered. But first of all, we'd have beginning materials inventory. And we have that given to us. That's 2. Of course, from there we have purchases. And I didn't put that on here. Let's assume material purchases. That's one thing I forgot. Let's assume material purchases is 10. Okay, so we have 10. That would give us materials available for production. And that would be 12 if we added the two together. So now we know our T account, we have at least 12 that's available. Our ending material balance is 3. So the way T accounts work, if we have a total of 12 as a debit in our inventory account, then it's either there in ending or it's not there, which means it's been transferred out. So of the 12, 3 is still there, meaning 9 has been transferred out. And that 9 we're going to call direct materials placed into production or used in production. Okay? All right, so that's our materials. So we had to purchase 10 more during the period, a total of 12 that was available. And since we had 3 left, that must mean we had used 9. 9 were transferred in to the factory. So at the factory, we had a beginning work in process inventory of 4. And here I'm just going to... So we have beginning of work in process inventory of 4. And here's where our costs flow in. So our direct material costs comes from our materials inventory. So we had direct materials that were transferred in of 9. We have direct labor, and this again was a given down below. We had direct labor of 6. And we have factory overhead costs for the period of 8. And again, those were given. So during the period, we had what's called manufacturing costs incurred during the period. And again, this is some terminology that we'll get used to using. But the costs that were incurred during the period are the direct materials, the direct labor, and the factory overhead. So if we add those all up, 9, 6, and 8, we get 23. So that's what we incurred during the period. Now, whoops. So if we had $4 of beginning inventory and we incurred 23 more, that means we had a total of $27 of manufacturing costs. We're going to call that total manufacturing costs. So in our T account, sorry for that line, in our T account then 27 is the number that's either going to still be there or it's going to be transferred out. We know what our ending work in process is. We were given that number, and that number was 5. That means of the 27 total costs, if 5 are still there, that means 22 were transferred out. And if you think about it, since this is the factory, what we had was we had 4 to begin with. We added 23. We had a total of $27 of costs that was incurred. 5 is still there, meaning there's 5 that's still in process. That means that $22 represents product that has been completed and transferred out of the factory into the finished goods warehouse. Now we're going to call that, instead of completed goods, we're going to call that cost of goods manufactured. So cost of goods manufactured represent the completed items. So So the completed items are transferred out into finished goods inventory. Okay, so finished goods inventory, we can keep going. We had a beginning balance of 3, right down there. So beginning was 3. In came 22 from the factory, so cost of goods manufactured was 22. And same thing. We had 3 to begin with. In came 22. We had a total of 25. And this 25 is what's called cost of goods available for sale. So we have 25 that are available for sale. Our ending finished goods inventory is 4. So if we had 25 available, 4 are still there, that means 21 were sold. And that's, again, that's cost of goods sold. So those are the amounts. That's the amount that goes out into cost of goods sold onto our income statement. So now what we can do is prepare our income statement. So we have sales are given, that was 36. Cost of goods sold, which is the number we just arrived at, which is 21. Gross profit, which is 15. We subtract the 2. We have operating expenses, which we were given as 9. Subtract that from 15. And we have net income of 6. So that's basically the entire chapter. That is, in effect, how costs flow through the 3 inventory accounts into cost of goods sold, how it shows up on the income statement. I think the key things for the chapter are this idea of what's direct materials, direct labor, what's factory overhead. There's some more information in the textbook concerning the definition of those. How the costs flow through the accounts, I think, can be probably easiest visualized by setting up these T accounts. Then it's a matter of understanding the terminology to make sure we have the terminology straight, so as not to get confused. And remember, it's always the beginning plus what's added gives us the total available. So for materials, it's the beginning plus what's added equals what's available. Then it's either still there in terms of the 3, or it's transferred out in terms of the 9. Same thing with work in process. We have a beginning amount, some costs come in, and we have a total amount, either 5, the amount that's still there of the 27, either it's still there, which is the 5, or the rest is transferred out, which is the 22. And again, same thing with finished goods. We had 3, 22 came in, there was a total of 25 available. Of that, it's either still there, which is the 4, or it's transferred out, which is the 21. So that's the way to think about it. I think the key is to get the amount that's the total available, and then from there, it's either still there or it's been transferred out. I think that's the simplest way to think about that. So that's chapter 15.